So if you're setting up a business, can a entrepreneur or a company director get that benefit as well? GST component taken out?
Well, the short answer is yes. It's not that going concern matter isn't restricted to entity type.
And does it need to belong to a particular industry, or anybody is like, I do nutrometics, so does that kind of curtail it from me from enjoying that privilege? Or
no, any business may be purchased GST free. The trick is that it has to meet the requirements as a going concern though, and the legislation is somewhat prescriptive about that. The main thing being that everything that's required to operate the business as a going concern is supplied. So a trap that some people fall into, for instance, is by coming into a business that requires a certain amount of machinery. So let's say you're buying a dry cleaning business, for instance, and that requires an amount of machinery, the dry cleaning equipment, for example. By chance, you might have some of this essential equipment already, and you say, oh no, I don't need that bit of machinery or that bit of machinery, can we drop the price down? Yes, that's fine, but you have just lost GST-free treatment as a result of doing that, because the seller is not providing everything that's needed to run that business as a going concern.
Right. Simon, you started your business, the first business at an early stage in your life. And then you recently started another business. So how did you start your first business as a sole practice? Did you get few friends to get together? What was the structure like?
There was no structure.
Right.
I was 16. Basically, I just went around and knocked on people's doors and said if I could clean out their gutters.
Right.
Stole Dad's ladder, and that was that.
Good.
And yeah, it was just something I was interested in.
Is that business still continuing?
Oh no. Oh
Right.
God, no, I couldn't get up on a roof anymore.
Right. And when you started your new business, how did you start, and what questions or how did you structure it?
Having a legal background, and one of my partners also having a legal background, we were fairly adamant that we wanted to structure the business as a company, just because of the tax advantages that are associated and the limitation of liability for the directors and the shareholders personally.
Right, so your structure is a company structure.
We're a
so
straight
he
company.
could start as, because he has got few friends to assist him and in doing the business with, he could go with a partnership.
Mm-hmm.
What is the difference or benefits in relation to either, in his situation, a small business, starting on his own? How do we start? Where do you get registered? And the benefits of incorporating it as a company or as a partnership, or tax implications as well. What are your thoughts?
Sure. Well, I'll deal with the structures
Sure.
question first. And so, well, the four basic types of structure, there's a sole trader, which you've mentioned, which is just operating business by yourself in your own name. There's partnership, trust, which hasn't been mentioned yet, but that's another structure and very common in Australia, and also companies. Companies have become more common in the last 15 years because the costs associated with registering have dropped substantially. Now, in just basically, I've covered off what a sole trader is. A partnership is where usually individuals, but you can have a partnership of companies, for instance, where, let's say, individuals just come together, operate through a trading name. So let's say Simon and Keith bookkeeping services. That would be a name that needs to be registered, but operating as a partnership with the tax implications of that, the income that the business earns would go straight through to the partners. So in the situation I just described, let's say Simon and I are in a 50-50 partnership and the business makes $100,000 profit. The partnership itself doesn't pay any tax. Simon would have to report $50,000 in his tax return and I would report $50,000 in my tax return. Contrast this with a trust. With a trust, it's divided the ownership of the property. So you have a trustee who controls the business, in this case, the business being the trust property. And the beneficiaries, though, are the ones who receive the income.
Who are the beneficiaries in a trust?
The beneficiaries are the people who we call who have the beneficial ownership of the property.
Like the entrepreneurs.
Yes, they're the ones who are supposed to receive the income. So the trustee might manage the business, but any profits from the business go to the beneficiaries. And a trustee can be a beneficiary in the one trust
Right.
as well. So with that business that year, any income that the business earns needs to go to the beneficiaries, depending on the terms that the trust was set up under. Some of that income might not necessarily be distributed, but there'll be a very high rate of tax that's paid on that. And so it makes sense to distribute as high a proportion of the income as possible. If the trust is what we call a fixed trust, this is determined in advance, and so it's generally an automatic process.
So there are different structures within the trust structure. One could get into and organize as his or her business structure. Is that correct?
Yes.
And
Yes.
different tax benefits.
Sure. Another type of trust structure is what we call a discretionary trust, which is quite common, and this is where the trustee can choose from year to year who receives what income. Now, an obvious reason why the pattern of distributions might change from year to year is for tax reasons, as the various beneficiaries have their personal circumstances change. One year, one beneficiary might be a university student, for instance, and studying full-time, so isn't earning an income. And then the following year has finished university, might be in a good-paying job, and now is starting to earn a lot more money. And so being in a higher tax rate, so they don't want to be receiving so much money. Of course, there are other non-tax reasons for wanting to distribute money. So the uni student, for instance, might need living costs, so that gets distributed there.
So with the sole practice, partnership, and the trust, compare these three to the company structure. What's the main benefit in relation to tax-wise if you're going on a company structure?
Going with the company structure, the main tax benefit, because there are a lot of non-tax benefits, companies at first instance pay a lower rate of tax than most individuals do. Most individuals are paying, at current rates, paying at least 32.5 cents in the dollar, whereas the corporate tax rate at the moment is 30%. Now, personal income tax rates go as high as 49% at the moment, not counting a number of other levies that they might be subjected to, whereas companies pay 30%. Now, from a tax perspective, when a company pays out profits in the form of dividends, they might be able to attach tax credits. If the company has paid tax on those profits, which they normally would have, they can attach those tax credits for the tax that the company has paid, and that might reduce the shareholders' own tax liability. So the owners of the company owns the business, but it is the shareholders who own the company. So that's the relationship between shareholders and a company.